All right, we're going to start with exercise number 4 on page 44. On this one, Kuhlman Construction Company began work on a contract in 2013. The contract price was $3 million. The company uses percentage of completion and the other information, so it tells you the cost that was incurred on an annual basis for both 2013 and 14, what the estimated cost to complete was at the end of both years, and then it goes on to tell you the billings and the collections during the year. So we're to compute the gross profit or loss that is recognized in both years based upon percentage of completion. So to do problems across the board such as this, we need to construct a table. The table starts with construction cost incurred to date. And then for this problem, we're going to have 2013 and 2014. And I'll leave room here because we'll eventually do one that spans 4 years. To that, the cost that we have already incurred on the long-term project, we're going to add the estimated cost to complete. That's going to be the total of those is our total estimated cost. All right? So we'll start with how much we actually incurred, whether it's direct labor, materials, or overhead, or subcontractors. How much have we incurred? How much do we expect yet to be finished, to finish the project, and then it'll give us a total. From that, we can calculate percentage complete. All right, so just to fill in the first 4 lines. We had $600,000 incurred in 2013 on this particular project. At the end of 2013, we expected $1.4 million to finish the project for a total estimated cost of $2 million. If you divide the $600,000 incurred thus far by the expected total cost of $2 million, you get how much complete? What's 6 divided by 20? 30%. All right? Everybody with me so far? So we're 30% finished on this $2 million job. That can give us now the revenue to date. And this particular contract is $3 million in total. So $3 million, 30% of that total contract is revenue to date of $900,000. If we remove revenue already recognized, which in the first year is 0, that gives us revenue for the current year. Current year subtract out the current year cost, which in this year was 600. And that gives us the gross margin or loss for the year. In 2014, we're going to incur another $700,000, bringing the total to $1,003,000. At the end of the 2014 year, we estimate another $1.2 million to finish this job. Now we have a total of $2.5. You've got estimators that continually working in a whole department with engineers and accountants and stuff like that. So it's always given to us. It's given to us in the problem that the estimated cost to complete, it's the second line in the table, is $1.2 million at the end of 2014. Yeah. No, because that was the estimate at the end of last year. It's the same number. It's just two different, it's a year apart. So last year, we thought another $101,004,000 will get us to the finish line. A year later, after we incur another $700,000 in cost, no, we're still got $1.2 million left to finish this project. All right? And this is what I mentioned. This is a great example, and you'll see that throughout the problems we do today, of project creep. When you have long-term projects, they will run amok on you if you don't keep a very, very, very tight control on it. So at this point, you more than likely had at least a serious conversation with your project manager, if not hired a new one. It's the reality of the construction business. All right, so now $1.3 million divided by a total of 2.5 gives us 52% complete. 52% of the $3 million contract price is $1,560,000. We've already taken 900 of that, leaving us with 660 for the current year revenue. Subtract out the 700 that we incurred during the year, and now we have a current year loss of $40,000. We're still making money on the entire job. We're still expecting to make $500,000. But the $300 that we took in the first year was way too optimistic. So in the current year, we have a small loss. And then hopefully in 2015, you finish this job and it stays in the 2.5 range and you wind up making, at that point, you'll get to book another $240,000 worth of profit. Yeah.
So that profit that we made,
yep,
is that incurred in 2014, so it's not there anymore?
No, it's there.
It's still there?
So if we did a comparative financial statement, comparative income statement, this is what it would look like. We would still leave the prior year alone. We don't go back and fix the prior year.
Okay.
We would leave the 300 last year, but we would take a 40 grand loss this year. We incurred 700,000 of a new cost. So the 1.6 plus 700 is the 1.3. Other questions? This is a very simple one. We're going to get increasingly more complex here in a second. All right, everybody good with this? All right. get a new erasers because I know my old eraser's got all that cleaner on it. And it's going to make a big mess if I use it. All right, we're going to do the very next problem. Problem number 5. Stay. On this one, Newburgh Construction Corporation contracted to construct a building for $400,000. So this one is a $400,000 contract. It began in 2013 and was finished in 2014. The data is as follows. So cost incurred and the estimate to complete. So at the end of the first year, we had incurred $200,000 in cost, and we estimated that we had $100,000 left. A total of $300,000. All right, so we're at the end of the first year, we're expecting to make $100,000 in profit on this contract. So how far are we complete? What's 2 divided by 3? 66 and 2/3, or 66.6667, thereabouts. Multiply that times the 400,000, you get 266,667 to round it to the closest dollar. Huh?
How much?
By the 400 total. Yeah, the contract price is 400. So 2/3 of $400,000 is $266,667. Or if you want to take it to the pennies, it would be $66.67. However you want to do it. Okay? We've recognized nothing prior, so that gives us $266 for the current year. We incurred $200,000 in cost, so that gives us a gross margin profit for the first year of construction of $66,667. The second year we finished the building, and on time and on budget. We finished the building, so there's 0 for estimate to complete. Total cost of $310. Never mind, wasn't on time and on budget. Thank you. 310. Yes.
Is 66,666
Percent. Yeah, not $66. All right, we're now 100% complete. That's $400,000, the total contract price, less the $266,667 that we took in prior years. That gives us $333. We've incurred $110 during the current year, leaving us $23,333 profit.
Put 100,000 with a percent on the site if
It's 100%, I'm sorry. Jeez. Yes.
Where does the 400,000?
That's 100% of 400,000.
Oh, okay.
Yeah, that's the contract price, the revenue price. All right? Does everybody understand the easy part before we get to the hard part, which is next? Yes? Problem number 5 on page 48. I knew it was going to make a mess.
Are we gonna use the same table?
Yeah, all of the lines are always the same in these calculations. We're always going to take the construction cost incurred to date, add it to the estimated cost to complete to come up with total estimated cost. Dividing the top line from the third line will give us the percentage complete. Multiplying that by the contract price will give us the revenue to date. Subtract out the revenue we've already recognized in years past. That'll give us the current year's revenue, and then we can subtract the current year's cost to come up with the profit loss. So yes, all of those lines are always going to be the same. This one is a 4-year project, 2015 and 2016. All right, Foreman Company has contracted to build a dam over a period of 4 years for $3 million. So our contract price on this one is $3 million. It gives us the same set of data that we've had before, the construction cost incurred during the year, plus the estimate to complete at the end of each of the 3 years while the dam is in process. And then it also gives us billings and collections. I'll wait until the very last one. The billings and collections is what you'll use to do the journal entries throughout the year. And I'll show you that here on the very last problem that I do, which is going to be problem number 6. All right. So, starting, we start the whole project by incurring $300,000 in cost. At the end of the first of the 4 years, we expect the contract to take another $2.2 million to finish. That's $2.5 million. So when we start this entire 4-year project, we're expecting to make $500,000 on the project. All right? If we divide the $300,000 incurred by the 2.5 expected, we get a 12% complete. We've spent 12% of the expected total. 12% of $3 million is $360,000. We've recognized 0, so that's a full 360. We incurred 300 in cost, and that gives us 60,000 in first year profit on this contract. In 2014, we incur another $1,100,000, and we expect $1.4 million to complete. So add it together, we now have incurred cost of a total of $1.4 million. We've got another $1.4 million to finish it for a total of $2.8 million. We're now 50% complete.
Why we didn't use the 1,100,000?
That's what our current year cost is. So the total cost that has been incurred since we started this program is $1.4 million. So we're adding it together. All right? Everybody good so far? So 50% of the contract price is $1,500,000. We've already taken $360,000. That leaves us $1,140,000. $1,140,000 for our current year revenue. Subtract the current year cost of $1,100,000, and we have a $40,000 gross profit for the second year of the project. I wanted to say the dam project. Thought maybe not. It's a Catholic school after all.
Yeah.
What?
Should that be $1,400,000 as the current year cost?
Thank you.
Yeah, that's what I was saying.
No?
No.
No, $1,140,000 plus 360 is 5.
So then, I'm sorry, but I just don't understand why the construction cost we use, the incurred today, 1.4 instead of 1.1.
Because we incurred just in 2014 1.1. That's how much that was. What the line says in your book here is it says construction cost incurred during the year.
Yeah.
So if we incurred $300,000 in year 2013 and $1,000,001 in 2000, there we go. Okay. Has everybody else got that? So it's a total of $1,400,000 because we want to add to the total what we expect to spend to complete the project in order to get a total cost on the project. All right? Are we good? Because the project's going to go off the rails here in 2015. So I want to make sure that you're caught up with this so far. All right. So in 2015, just for the year, we incur $863,000, bringing the total cost incurred to date to $2,263,000. We expect to spend another $837,000 to finish the project. Ruh-roh. Now our total cost to complete is $3,100,000. Does anybody see a problem with that? What's the contract price, once again, on the dam project? $3,000,000. Now we're losing money on the entire 4-year project. This is where rules come in. If we take the $2,263,000, divide it by the $3,000,001, we are 73% finished with the project. 73% of $3,000,000 is $2,190,000. We've taken $1,500,000 in revenue in prior years, leaving us with $690,000 in current year revenue. All right? The rule for long-term construction under U.S. GAAP is that we have to recognize the loss on the project plus remove all of the profit that we had previously recognized in the year where it becomes apparent that we're going to lose money on the entire project. So we know now we're going to lose how much money? $100,000. How much have we taken already in profit in prior years? So what needs to happen here is we need $200,000 loss in 2015. Yes.
Why do we have to do that?
As that's the rule. It's in keeping with the conservative nature of accounting. We want to give the readers of the financial statement all of the bad news. No sugarcoating it. All right? The project's going to lose $100,000. We know at best the project is going to lose $100,000. We haven't finished it yet. So we need to take the $100,000 loss and we need to wipe out the transgressions of prior years. So the full $200,000 has to hit the current year. So how do we get from here to here? We have to accrue $890,000 in cost. Even though we only actually incurred $863,000. So we're over accruing expenses.
So you always put first the loss and then
Correct.
calculate it?
Correct.
Okay.
All right, does that make sense? So in the final year, we finished the project at $3,000,001. The new project manager that we brought after we fired the first one got it done. Now we're 100% complete. We have $3,000,000 total contract price, of which we've taken. Yeah, this is all negative here. We've taken $2,190,000. So that leaves us $810 for the current year, and $810 cost to give us a 0 profit margin. Now, in reality, we didn't spend $890 here, nor did we spend $810 here. In reality, in the 2015, we only actually spent $863, and then we spent $837 in the following year. But we accrued a full $890 in 2015 in order to force the $200,000 loss. Take all of the bad news in the year in which we know it, rather than parceling it out. It could be argued, theoretically, that you really should have only taken 163,000 here, and then 32,000 or 37,000 here. You could have argued that. 27. But that's not what we're going to do. We're going to force all of the bad news immediately. Okay? And no, I won't give you a loss on a contract on the midterm. So, I'm not that cruel.
You have to report the 200,000?
200,000 in the year in which you know the project is going to lose that much money. Yes, ma'am.
Can you explain again how to get the 200,000?
Okay, we have $690,000 worth of revenue. That's what's left. We're 73% finished. So that gives us $2,190,000 worth of revenue to date. We've already taken $1.5 million of it. That leaves us $690,000. We need to get from $690,000 to $200,000. So how do you get there?
I'm asking how we calculate that we need a loss of 200,000.
Okay, the whole project is going to lose $100,000. Plus, we've already taken $100,000 in profit on the project. So in total, we need to have a $200,000 loss in 2015. To wipe out the profit that we erroneously have already reported, and to truly give the readers of the financial statement the full picture on the project of the $100,000 loss. And then in the final year, we have 0 left to accrue.
Why isn't there a loss for 2016? Why is it 0 now?
Because we did complete it the way we estimated. The only time you would have a loss here is, let's say that went to $3,150,000. All right, then you'd have another 50 grand to take, because in reality you're losing 150,000 on it, not just 100,000. That'd be the only time you'd have additional losses in the final year.
So did we just ignore that 837?
Yeah, what happened with the last 2 years, the 863 and the 837 is that in 2015 we took 890. So we over accrued the cost by $27,000. Then we get to under accrue it by the equal of another $27,000 in the following year, because in reality the total is $3,000,001. Yes? Maybe?
For the 810 for the current cost, that you subtract out.
Yes, that's what's left to accrue on the contract. Yeah, yeah. To get you to the $3,000,001 total. That's all that's left. So in both years, this year and in this year, those two circled numbers are plugs, to use a very bad accounting term.
So if the,
Because we know how much revenue and we know how much loss we want to take in both years. So we just force the cost number to get us there. Yes?
so if the project was finished in 2017, we would have to use these numbers that are 2016?
Yes, even if it went on to 2017, you'd have a zero, and nothing changed. So let's say this was now at $2,009,000 with 200,000 left. So we're still expecting a 3.1. Then this still would be zero. All right? Whatever the percentage was and the revenue and stuff like that. So you would calculate how much revenue you can take. You would then force the cost number. And then the final year you would have the 200,000, the remaining 200,000 of revenue and 200,000 of cost. And zero, assuming nothing, it didn't continue to creep. It didn't go any worse than the $3,000,001. All right? Yes? Not sure about the homework. I'll have to take a look at it. Maybe the homework's got a loss on it. I'm guessing. All right, let's do one last one, because then I want to, once I calculate the numbers, it's just a 2-year project, but then I want to show you the journal entries that you need to do in order to, actually it's a 3-year project, but I'll show you the journal entries. All right, the very next problem, 6 on the same page. On this one, Rice signs a contract, another dam, another dam project, over a period of 3 years for a price of $10 million. So now we've got a contract price of $10 million. Construction incurred, and then they give you the numbers in each time. And this one is going to be on contract and well, there's a creep that happens in the second year. Okay, so we have $2 million incurred during the first year, with an estimated cost to complete of $6 million. So at the end of the first year, we're expecting to make $2 million on this contract. We're now 25% finished, which gives us $2,500,000 in revenue to date. We've recognized none of it. $2,500,000. with current year cost of $2 million. $500,000 is the current year profit. Year 2, we incur another $4 million in costs, bringing the total to $6 million. Unfortunately, our estimated cost to complete is unchanged. We're expecting to cost another $6 million to finish this project, for a total of 12. We're now 50% finished. That's $6 million. We've taken already 2.5, leaving us with $3,500,000. I'm sorry, thank you. Well, that would have been nice. $5 million, leaving us $2,500,000. What does this number need to be? Exactly. Does everybody see that? This number down here needs to be $2,500,000 loss. Because we're expecting to lose $2 million on the total project. We've already taken $500,000. So our 2014 loss has to be $2,500,000.
Why is it a loss?
Well, because we're building it for $12 million and we're only charging them $10.
Oh, okay.
Not a good deal. If you think it's a good deal, I want you to do all my construction projects from here on out. So $5 million is the cost that we need to incur. We need to accrue $5 million worth of loss. In reality, they do finish it for $12 million. Now it's 100% complete. You take the full 10. We've taken 5 already, leaving us 5. We only need to accrue $5 million, giving us 0 profit for the final year.
$10 million is from the
Contract price, what we signed up for to build the dam for. You know there's a graduate assistant someplace that named both of these projects. Somewhere along the line, somebody thought, oh, let's call it a dam project. Okay? So does everybody understand, first of all, and most importantly, how to calculate it if there isn't a loss? The earlier examples I gave you. You just take the percentage, multiply it by the revenues, subtract revenue that you've taken prior, subtract out the current year's cost that you're incurring, and that gives you the gross margin all along. All right? Because the one last step I want to do here is to show you the journal entries that you would then book on an annual basis based upon this set of numbers. Yes?
So, like in the first problem, how the
Right, that's just a loss in current year, and if we'd have continued that problem, we'd have had a profit in the final year.
But if you like had that and you went over the revenue of the
It's
contract-
not until we get to this point that this special rule comes in.
Yeah, so like if that were to happen, like with this, where we had a loss in the first year,
Uh-huh.
and we went over the contract the second year, would we just, how would we?
Well, if there was a loss the first year, then we would have only taken, we wouldn't have had to wipe out the profit from prior year. We'd only have to take whatever lost the first year in order to get us to the total contract price. So let's say if that was a $500,000 loss, for instance, based upon, what we had up here, that we would have then only had to take $1.5 million here, and we would have backed into the cost number to get us to that. Because the total loss is $2 million. If we'd already taken half of it, then, okay? Yeah,
Is that 500,000 added to the two?
correct.
Right?
It's added to the 2 million loss in order to get to here. Yes.
On the third year, we put, 5 million on current year cost. Hello.
Yes, because that's what's left. Because from here to here, we only incurred 4 million, but we had to accrue 5 in order to force the loss. All right? So we over accrued $1 million in 2014.
So that's the reason you're not using.
So we under accrue $1 million in the final year in order to get it to zero.
Because normally we would use the 6 million.
Normally we would have used the 6 here and the 4, I'm sorry, normally we would have used the 4 here and the 6 here, yes. But because of the special rule,
Yes.
we needed to put 5 in here, not 4.
So
So that only left us 5. Because in total, it still has to add up
yeah. But
to the
it
12.
also affects the last year.
Yes,
Okay.
yes. It's always going to affect the last year. Okay? We ready for journal entries? Well, whether you're ready or not. Okay. I'm going to put debits and credits under each of those years. All right, day in and day out, as you charge labor, materials, subcontractor invoices, and factory overhead to this construction job, you're going to debit construction in process. So as you accumulate cost on a daily basis while you're working this job, you debit this work in process inventory in essence. Okay? And the credit is going to come from a whole bunch of stuff. I mean, the credit's going to come from accounts payable, it's going to come from inventory. There may be some cash in there, who knows? Okay? So in the first year, we had $2 million incurred. And then in the second year, we had $4 million. We'll leave it for right there, right at the moment. Then you have billing milestones. in long-term contracts, you have certain stages of the project that you then in turn get to bill the customer, and they pay you for accomplishing whatever that milestone is. You know, final blueprints are signed off, foundation is poured, the walls are up, whatever the milestones are. So at that point, you're going to debit accounts receivable. And credit a contra inventory account, partial billings. And in this particular contract, $1,500,000 is the first year, $3,500,000 the second year, and the last billings of $5 million. Then you're going to collect on some of these receivables. So you're going to debit cash and credit accounts receivable. And we collected $1,300,000 the first year. $3,600,000 the second year. And then $5,100,000 the final year. All right. So these occur throughout the year as the transactions are booked. All right. At 12/31, you then need to book for the calculation of expenses and revenues. So you're going to debit construction expense. And that was the $2,000,000 the first year. But because of our loss, it's not $4,000,000, it's actually $5,000,000 the second year. Leaving us with $5,000,000 the final year. You're then going to, in the first year when we were still expecting a profit, you're going to take the gross profit, and this is very unusual, but this is what we do. And you're going to put it in the inventory account. So the inventory account is not only going to hold the cost that you've spent on the project, but the profit that you're taking in earlier years. And the reason that that's not overinflating the current asset portion of the classified balance sheet is we have this contra inventory account for partial billings. So you're going to report the cost and the profit in this work in process account, construction in process, but then you're going to subtract the partial billings to lower down the inventory account by the invoices that you've let out on the contract. So that evens it out, in theory. All right? Then you're going to take the construction revenue as a credit, and that was $2,500,000 in the first year. In the second year, it was $2,500,000 also. And in the final year, it was $5,000,000. Oh, I'm sorry. Yep. Okay, now, the problem is, in that 2014, this construction and process needs to go to a credit balance. All right? Because we now know that we're going to lose money on it. We're going to lose $2,000,000. So we need to take it from that $500,000 debit that we put in there to a total of $2,000,000 credit. So to get there, we need to credit it $2,500,000. Well, we need to wipe out the 500. So we're going to wipe this out by crediting it 500. That brings the inventory account to 0. And then the last thing we're going to do is add in a provision for loss on contract. And that's the $2,000,000. So that in the final year,
I'm sorry.
Yes.
You get the 500,000.
well, we put 500 in, we need to take 500 out. Okay? So all I'm doing is reversing the entry from 2013. All right? And then I'm creating this provision, this loss here. Because I'm going to turn around and use that in the final year by allowing me to put in a, remove it, God bless you. God bless you again. Remove the $2,000,000 in 2015, leaving us only $4,000,000 in construction because we only had $4,000,000 left to accrue. So the construction in process is only going to go up $4,000,000, whereas what we actually spent was $6,000, because that's what we actually incurred in the last year. So that's what came out of direct labor, materials, subcontractors, and overhead was $6,000. So that's our credit. We're going to wipe out that. And then the very last entry is we're going to zero out the partial billings by debiting and we're going to zero out the inventory account and that's the end of the project.
Where did you get that partial billing? From
We've been building that up year after year as we've been sending the invoices out. So in the first year, this is that contra inventory account. All right? So in the first year, it had $1.5 million in it, and we put another $3.5 million in the second year. So that's a total of 6. And then, no, total of 5. And then we put another $5 million in it that last year. So the balance in the partial billings at the end of the project was $10 million. That was the contract price for the dam. But also, in construction and process, we put in $2 million, $4 million, and $4 million, okay? Because this is construction and process, $2 million, $4 million, and $4 million for a total of 10.
So you add all years?
Yes. Yeah, because you've been accumulating it. It's a balance sheet account. You've been accumulating it all along the way and rolling over the balances. So at the end of the project, they both have $10 million in it. And in a normal project where you didn't have the loss, it would also be $10 million because you would have been booking into construction and process the gross margins each year. So if you didn't lose money on this, if we still made, let's say, $1 million, and we took $500 the first year, $300 the second year, and $200 the last year, at that point, construction and process would still have $10 million in it because it would have the cost plus the margins. Yes? Some of you are going, isn't spring break here yet? Goodness gracious. All right. What did I give you for homework? Does anybody remember? 4, right? Yeah. 17.4. So let's see here. That one was a 700. And we've got 40, 60. You make money on that one. Okay. So you won't have any of this nonsense. All right. And just do the percentage of completion on it. Don't do the completed contract. Because under a completed contract, the same thing goes on here, here, and here. It's just this entry, this construction expense and construction revenue does not incur. You don't do that at all. You don't book that entry here or here until the final year and take all of it the final year. So that's why I don't really cover it.
So we do.
Because it's just one. Yeah, this percentage of completion will be plenty. All right? Any questions? All righty.